Welcome to the Explainer. Today we're talking about something that is, frankly, a real nightmare for investors. We're going to look at how the rules of the financial game can be changed in the blink of an eye, and more importantly, how you can make sure your savings aren't on the losing end when it happens. Let me paint you a picture. You've made a great investment, it's doing well, and you go to bed feeling pretty good about it. But when you wake up the next morning, poof, it's all gone. Your entire position has been sold off and at a loss. And the craziest part? It wasn't because the market turned against you. It was because someone behind the scenes changed the rules of the game while you were fast asleep. Now, this isn't some made-up story or a hypothetical. This is exactly what happened to silver traders on the morning of December 28th. They watched their winning investments get completely wiped out in just a few hours. So let's take a closer look at exactly how this nightmare unfolded. Wow, just look at that. The price didn't just dip, it completely fell off a cliff. Over in Shanghai, silver crashed by nearly $8 an ounce. At the same time, in New York, the market just plunged 6% almost instantly. So what on earth could cause this kind of chaos? You'd think it had to be a huge shift in supply or demand, right? Well, nope. It was something else entirely. The real culprit was a single, powerful tool. A hidden weapon, really, that was used by the exchange itself. And that tool is something called margin. So what in the world is margin? Well, the best way to think about it is like a security deposit. It's a tool that lets you control a whole lot of an asset, say $400,000 worth of silver, with just a fraction of that, maybe $22,000 of your own money. It's powerful for sure, but here's the kicker, the really dangerous part. The exchange, who is like the landlord in this scenario, can increase that security deposit whenever they want, without warning, and you have to pay up immediately. And wouldn't you know it, that is exactly what the COMEX exchange did. Just like that, they hiked up that security deposit by 14%. Now, if you held, say, 10 silver contracts, that meant you suddenly needed to find an extra $30,000 in cash. And you had to have it within hours. If you couldn't, well, there were some very serious and very automatic consequences. And that's where the dominoes really started to fall. The margin hike hit, and most people just don't have that kind of cash sitting around. So their brokers were forced to automatically sell their silver positions. All of that forced selling pushed the price of silver down, which in turn triggered even more automatic selling from other accounts. It just became this vicious downward spiral that took a small dip and turned it into a full-blown market crash. If you like our videos, please like, share, and subscribe to follow us so you won't miss any exciting updates. So whenever you see something this chaotic happen in the financial world, you have to ask yourself one simple, timeless question: who benefits? And in this case, if you follow the money, the trail leads directly to a very specific group of very large institutional players. You see, there was a staggering number of these things called options contracts. Basically, a massive pile of bets that were all set to pay out huge if the price of silver stayed high. This put the big players who were betting against silver, the short sellers, in a really, really tight spot. They were on the hook to potentially deliver 205 million ounces of physical silver, a whole lot of metal that they almost certainly did not have. A catastrophic loss was staring them right in the face. So here you have the two sides of the coin. On one side, you've got everyday traders, the longs, who are betting the price will go up. Their biggest worry, a sudden demand for more cash that they don't have. And on the other side, you've got the big institutions, the shorts, who are betting the price will fall. And their biggest fear, the thing that keeps them up at night, is something called a short squeeze. That's when the price rockets up and forces them to buy back their bets at enormous, potentially unlimited losses. Now, of course, the exchange will tell you they were just managing risk in a volatile market. But you have to admit, the timing of this rule change was, well, incredibly convenient for those short sellers who were on the brink of financial disaster. This move stopped the rising prices cold and pretty much let them right off the hook. You know, if this whole story is giving you a sense of déjà vu, it really should. This isn't some brilliant new trick they came up with. It's an old, dusty playbook that has been used for decades to shake smaller, everyday investors right out of a winning market. I mean, just look at the pattern. We saw this with silver way back in 1980. We saw it again with oil during that massive run-up in 2008. We even saw it with Bitcoin futures in 2017. A market gets hot, regular folks start piling in, and then bam, a sudden rule change pushes them right out. And it often works out very well for the bigger players who can absorb the shock.
So after hearing all of this, the really important question is, what can you, as an individual investor, do about it? What are the takeaways here? Well, the good news is, understanding what happened gives us 5 very clear, very practical rules to help protect our own financial well-being.
Okay, think of these 5 rules as your financial shield. First, always keep a cash cushion. Never operate on the bare minimum margin. It's best to have at least 1.5 to 2 times the requirement in reserve. Second, size for a crisis. Make sure your position is small enough that you could survive if they suddenly doubled the margin requirements on you. Third, know both risks. You're not just betting on price changes, you're also betting that the rules of the game won't change on you mid-play. Fourth, watch the calendar. Be extra cautious when a large number of options are about to expire. That can be a huge red flag for this kind of intervention. And fifth, the old classic, diversify. Don't put all your eggs in one basket. Following these rules gives you the staying power to weather these kinds of storms.
At the end of the day, this whole event is a powerful reminder of a fundamental truth of investing. Your number one job isn't to make a profit, it's to preserve your capital. The rules can and do change, so the only real question left is, are you prepared for it? Thanks for watching.